A daring new alliance is poised to flip the global energy map upside down. Here's why the oil game will never be the same. A single pipeline deal could dethrone America's grip on global oil markets overnight. But it's not just about crude. Electric vehicles are caught in the crossfire, and one bold move might spark a trade war no one saw coming. The global energy arena is on fire, and Canada and China are fanning the flames. Canada's unleashed the $34 billion Trans Mountain Pipeline Expansion, TMX, a juggernaut tripling its export capacity to 890,000 barrels per day, breaking free from old constraints to feed Asia's $15 trillion energy market. For years, Canada's 3.88 million daily barrels were locked in a one-way street, sold at a discount due to pipeline limits. Now, TMX connects Alberta's oil sands to China's refineries, hungry for heavy crude. Enter China's Rangshan Petrochemical, a refining titan that's clinched a multi-year deal with Suncor Energy to ship 200,000 barrels per month starting June 2025. Rangshan set up a Calgary hub, aiming to secure 10% of TMX's capacity by 2026, with eyes on giants like Cenovus and Canadian Natural Resources. This is no mere trade, it's a power shift. China's imports of Canadian crude hit 184,000 barrels daily in 2024, up 22% and rising fast. Canada's betting on $20 billion in annual economic gains, chasing energy sovereignty. Can Canada and China redefine the energy order? Or will their bold pivot spark chaos? Dive in with us as we unravel this high-stakes saga. You're about to see history pivot before your eyes. Let's start with a moment that's rewriting history. On May 1st, 2024, Canada flipped the switch on the Trans Mountain Pipeline Expansion, a $34 billion colossus that's been decades in the dreaming. This isn't just a pipeline, it's a lifeline, stretching over 1,150 kilometers from Alberta's oil-soaked heartland to the jagged Pacific coast. TMX triples Canada's export capacity to 890,000 barrels per day, a volume that could fill 50 Olympic-sized swimming pools daily. To grasp its scale, picture 20 new storage tanks and an upgraded Westridge Marine Terminal ready to load crude onto massive tankers bound for Asia's hungry refineries. For years, Canada's oil was trapped in a chokehold. The US gobbled up 98% of Canada's 3.88 million daily barrels, often at a punishing $15 per barrel discount due to pipeline bottlenecks, according to the International Energy Agency. Refineries in the US Gulf Coast and Midwest grew fat on cheap Canadian crude, while Canada's producers bled profits. TMX changes everything, cracking open Asia's $15 trillion energy market like a long-sealed vault. Refineries in China, South Korea, and India prize Canada's heavy sour crude for its compatibility with their complex plants, offering premium prices that could transform Canada's economic fortunes. But this triumph didn't come easy. The Canadian government bought TMX in 2018 for $4.5 billion from Kinder Morgan, stepping in when private investors balked at mounting risks. Costs ballooned from an initial $7.4 billion estimate per CBC News as legal battles and delays piled up. Environmentalists raised alarms about spill risks in the Salish Sea, warning a single accident could devastate marine ecosystems and coastal communities. Indigenous groups, including the Tsleil-Waututh Nation, sued over inadequate consultation, arguing the pipeline threatened their lands and waters. A 2020 Supreme Court ruling finally cleared the path, but not without fierce debate that exposed Canada's deep divides over energy and environment. Ottawa's betting big on TMX's promise. The pipeline is projected to boost Canada's economy by $20 billion annually, fueling jobs, tax revenue, and regional growth. To counter spill fears, the government's earmarked a $1.5 billion spill response fund, touting enhanced monitoring and rapid response systems. Yet critics remain unconvinced, pointing to the pipeline's route through pristine wilderness and fragile coastal zones. TMX isn't just infrastructure, it's Canada's declaration of energy sovereignty, a bold move to break free from US dominance and chart a global course. Alberta Premier Danielle Smith called it a new dawn for our province, while industry leaders hail its potential to elevate Canada among the world's top oil exporters. This isn't just about oil flowing west. It's about power shifting east. Canada's standing at a crossroads, with Asia's markets beckoning and the US watching warily. The question is, can Canada seize this moment, or will old ties pull it back? Hold tight, because China's about to make a move that shakes the board. While Canada celebrated TMX's launch, China was plotting its next move. Enter Rangsheng Petrochemical, a Chinese refining titan with an 800,000 barrel a day hunger for crude. This isn't a company that waits for opportunities. It creates them. In June 2025, Rangsheng struck a game-changing deal with Suncor Energy, Canada's heavyweight producer, locking in 200,000 barrels per month to ship from Burnaby to Zhejiang. According to Bloomberg, initial cargoes are already booked on very large crude carriers, massive tankers that signal China's serious intent. But Rangsheng didn't stop there. The company planted a flag in Calgary, Alberta's oil capital, setting up a sleek downtown hub as its North American foothold. This isn't a token gesture. Rangsheng's diversifying away from Middle Eastern oil, spooked by geopolitical volatility in the Gulf. Canada's heavy crude, churned out by Alberta's oil sands, is a perfect fit for China's state-of-the-art refineries, which thrive on complex, sulfur-rich blends. Reuters reports Rangsheng operates one of China's largest single-train refineries, a subsidiary of Zhejiang Rongsheng Holding Group, giving it the muscle to reshape supply chains. The deal with Suncor is just the opening salvo. Rangsheng's courting other Alberta giants, including Cenovus Energy, which pumped 800,000 barrels daily in 2024, and Canadian Natural Resources, alongside global players like BP and Shell, with oil sands stakes, per the Globe and Mail. Their contracts use FOB terms, a cunning move that lets Rangsheng control the oil from loading. If prices spike in Japan or India, they can reroute tankers for a quick profit. S&P Global estimates $2 to $3 per barrel in arbitrage gains. This flexibility makes Rangsheng a predator in the oil market, not just a buyer. Steering this operation is Wang Jia, a 20-year oil veteran who built PetroChina's Canadian trading arm in the 2000s. With deep ties and deal-making prowess, Wang's driving Rangsheng's ambition to secure 10% of TMX's capacity by 2026, per Energy Intelligence. This isn't a quiet trade play. It's a strategic gambit that could tilt global energy flows toward Asia. China's imports of Canadian crude already hit 300,000 barrels daily in 2024, up 22% from 2023, per China Customs data. With TMX flowing, that number's poised to soar. Why does this matter? Because China's not just buying oil, it's buying influence, weaving Canada into its long-term energy plans. For Canada, it's a chance to diversify and thrive. But for the US, it's a wake-up call, and they're not taking it lightly. Speaking of the US, they're about to throw a wrench in the works. Now, the plot thickens. Donald Trump, eyeing a White House return, unleashed a bombshell: a 10% tariff on Canadian oil and gas. Billed as a boost for American manufacturing, this move is a guillotine over Canada's economic neck. In 2023, Canada's energy exports to the US totaled $200 billion, per Statistics Canada, with US refineries processing 3.9 million barrels of Canadian crude daily. A tariff could slash producer profits by $10 billion annually, per the Canadian Association of Petroleum Producers, hitting Alberta's oil patch like a sledgehammer. The ripple effects are brutal. Goldman Sachs warns US pump prices could jump 80 cents per gallon, a political third rail in an election year when voters are already squeezed. Here's the irony. The US relies on Canada for 60% of its crude imports, making tariffs a dangerous game of chicken. If Canada diverts more oil to Asia, where China's imports rose 22% to 300,000 barrels daily in 2024, US refineries might scramble for pricier alternatives. Wood Mackenzie estimates Saudi or Venezuelan oil could cost $5 to $10 more per barrel, hiking expenses for refiners and consumers alike. Canada's not rolling over. In March 2025, then the Canadian federal government launched a $6.5 billion Global Markets Accelerator Plan, funneling $5 billion to help oil exporters tap Asia and $1 billion to shield farmers from US trade spats. The tariff threat supercharged Canada's pivot, with deals like Suncor's Rangsheng contract inked weeks later. But the stakes go beyond oil. Canada's exploring natural gas exports with LNG Canada, a $40 billion project in Kitimat, BC, set to ship 14 million tons annually to Japan and China by late 2025, where gas demand's up 8% yearly, per the IEA. This is a full-blown energy war. Trump's tariffs aim to strong-arm Canada, but they risk backfiring, fraying North America's energy ties. Canada's compass is spinning toward Asia, leaving the US to grapple with a self-inflicted wound. The question is, how far will this escalation go? But wait, there's another battlefield, and it involves Tesla. You're not going to believe this twist. The energy war's spilling into new territory, electric vehicles. On April 1st, 2025, Canada dropped a bombshell on Tesla, freezing rebate payments under its EV incentive program. The reason? Suspicions of fraud, after Tesla allegedly sold 8,753 vehicles across 4 Canadian dealerships in a single weekend in January 2025, one car every 30 seconds. Transport Canada halted $43 million in rebates, launching a case-by-case investigation, per Reuters. This isn't just a clerical dispute. It's a calculated strike in a broader trade war. Rewind to March 26, 2025. Trump slapped a 25% tariff on Canadian auto imports, targeting Canada's $51 billion auto sector, where 93% of exports flow to the U.S. Prime Minister Mark Carney, speaking in Windsor, Canada's auto heartland, called it a direct assault on our workers. Tesla, led by Trump confidant Elon Musk, became collateral damage, with Canada yanking it from the zero-emission vehicles program. This freeze sent Tesla's stock crashing 5.6% to $272.06, erasing billions in market value, per the transcript. Tesla's no stranger to gaming the system. Since 2019, it's pocketed $713 million in Canadian EV incentives, more than any rival, fueling its dominance. But in early 2025, a $43.1 million rebate application raised eyebrows, tied to that suspicious sales surge. The Canadian Automobile Dealers Association cried foul, accusing Tesla of manipulating the program's budget, which was nearing depletion. Transport Minister Chrystia Freeland acted swiftly, halting payments and sparking a firestorm. This isn't Tesla's first controversy. In 2019, when Canada capped eligible EVs at $45,000, Tesla rolled out a stripped-down Model 3 at $44,999 with a paltry 151-kilometer range, a sham model, critics said, that unlocked millions in subsidies. Now, Canada's drawing a line, signaling it won't be bullied by US-linked giants. The auto sector's a battleground, with Canada fighting to protect jobs and sovereignty against Trump's tariffs. But for Tesla, it's a multi-million-dollar gut punch, threatening its North American foothold. Think this is just a North American spat? Guess again. China's got skin in this game. Zoom out, and the energy war's global stakes come into focus. Canada's pivot to Asia is a radical redraw of the energy map, challenging decades of US dominance. LNG Canada, a $40 billion project in Kitimat, British Columbia, led by Shell and PetroChina, will ship 14 million tons of natural gas annually starting late 2025, targeting Japan and China, where gas demand's up 8% yearly, per the IEA. Alberta Premier Danielle Smith projects $500 billion in export revenue by 2035, calling it the cornerstone of our energy sovereignty. But Canada's not stopping there. Conservative leader Pierre Poilievre is pushing to revive the Energy East pipeline, aiming to supply Eastern Canada and Europe. Trudeau's eyeing Arctic LNG routes to Germany, tapping into Europe's post-Russia gas scramble. Meanwhile, Hydro-Quebec and Ontario Power exported 42 terawatt-hours of hydropower to the US in 2022, enough for 4 million homes, raking in $2 billion, per Natural Resources Canada. Canada's emerging as a versatile energy titan, with its sights on the Indo-Pacific's $47.9 trillion economy. For the US, it's a rude awakening. Tariffs could drive Canada to ship more to China, forcing US refineries to compete with costlier sources. Europe's auto leaders warn of a tariff spiral, with Tesla's sales plummeting 47.1% in early 2025, dropping its market share from 2.5% to 1.4%. China's the wild card, with EV giants like BYD and NIO undercutting Tesla, while Rangshan secures Canada's crude. Canada and China, despite Huawei tensions, keep oil as a pragmatic lifeline, per Bloomberg. No sanctions touch this vital trade. This is a fight for energy dominance. Canada's repositioning as a global player, the US risks isolating itself, and China's playing a patient, strategic game. The world's energy future hangs in the balance, and every nation's jockeying for position. So, what's the end game in this power struggle? The answers might shock you. As the energy war rages, the horizon's clouded with questions. Can Canada cement its role as a global energy leader? With TMX pumping 890,000 barrels daily and LNG Canada gearing up for December 2025, it's making a bold case. Ottawa's investments, $6.5 billion for global markets, hydropower exports, and Arctic LNG, signal a nation refusing to be a U.S. appendage. Will China overtake the U.S. as Canada's top energy buyer? With 184,000 barrels daily and rising, China's hunger is undeniable, and Rangshan's Calgary hub is a beachhead for more. Then there's the U.S. Trump's tariffs, 10% on oil, 25% on autos, could cost American consumers dearly, with 80-cent gas price hikes and pricier cars looming. The U.S. risks alienating Canada, pushing it deeper into Asia's orbit. For Tesla, the outlook's grim. Canada's $43 million rebate freeze is a body blow, compounded by an 11% U.S. sales dip in January 2025 and Europe's collapse. Musk's political lightning rod status, from backing Germany's far right to Trump ties, is tarnishing Tesla's brand, per the transcript. The global stage is watching. Brazil's Lula warns Trump's policies threaten free trade. Europe's Ursula von der Leyen vows to shield consumers. Germany's auto giants predict a growth-stifling tariff spiral. Canada's defiance, excluding Tesla, embracing Asia, is a signal of strength, but risks abound. A spill, a trade misstep, or a U.S. retaliation could derail its ambitions. This war's reshaping industries, from oil to EVs, with ripple effects on jobs, prices, and geopolitics. Where do you stand? Is Canada's pivot a masterstroke or a high-stakes gamble? Is the U.S. shooting itself in the foot? Drop your thoughts below and hit subscribe for more deep dives into the clashes shaping our future. The future hangs in the balance, and every nation's jockeying for position. So, what's the end game in this power struggle? The answers might shock you. As the energy war rages, the horizon's clouded with questions. Can Canada cement its role as a global energy leader? With TMX pumping 890,000 barrels daily and LNG Canada gearing up for December 2025, it's making a bold case. Ottawa's investments, $6.5 billion for global markets, hydropower exports, and Arctic LNG, signal a nation refusing to be a U.S. appendage. Will China overtake the U.S. as Canada's top energy buyer? With 184,000 barrels daily and rising, China's hunger is undeniable, and Rangshan's Calgary hub is a beachhead for more. Then there's the U.S. Trump's tariffs, 10% on oil, 25% on autos, could cost American consumers dearly, with 80-cent gas price hikes and pricier cars looming. The U.S. risks alienating Canada, pushing it deeper into Asia's orbit. For Tesla, the outlook's grim. Canada's $43 million rebate freeze is a body blow, compounded by an 11% U.S. sales dip in January 2025 and Europe's collapse. Musk's political lightning rod status, from backing Germany's far right to Trump ties, is tarnishing Tesla's brand, per the transcript. The global stage is watching. Brazil's Lula warns Trump's policies threaten free trade. Europe's Ursula von der Leyen vows to shield consumers. Germany's auto giants predict a growth-stifling tariff spiral. Canada's defiance, excluding Tesla, embracing Asia, is a signal of strength, but risks abound. A spill, a trade misstep, or a U.S. retaliation could derail its ambitions. This war's reshaping industries, from oil to EVs, with ripple effects on jobs, prices, and geopolitics. Where do you stand? Is Canada's pivot a masterstroke or a high-stakes gamble? Is the U.S. shooting itself in the foot? Drop your thoughts below and hit subscribe for more deep dives into the clashes shaping our future.